The year 2025 will be remembered in financial history as a period of profound uncertainty, where investors grappled with stubborn inflation, tight financial conditions, and persistent global stress. In this challenging environment, two assets, often grouped together as hedges against economic turmoil, took dramatically different paths. Gold, the ancient store of value, performed its traditional role with remarkable precision, climbing steadily to new heights. Bitcoin, the digital upstart, experienced a year of extreme volatility, rocketing to a new all-time high before suffering a severe correction. This split, which we now call the Great Divergence, offered a masterclass in how different assets respond to the same macroeconomic pressures, revealing their unique characteristics and fundamental drivers. For months, both gold and Bitcoin seemed to be responding in tandem to the growing economic anxieties that defined the year. As worries about slowing growth and geopolitical tensions mounted, investors sought refuge outside of traditional stocks and bonds. Both assets benefited from this flight to safety, climbing together through the first half of the year. However, as the summer drew to a close, a clear and undeniable split began. Gold continued its methodical upward march, while Bitcoin faltered and then fell sharply. Understanding this divergence is not just an academic exercise, it provides crucial insights into the very nature of these two distinct asset classes and what they represent in a modern portfolio. We'll explore the factors that drove this remarkable separation in performance. We will delve into why gold became the undisputed safe haven champion of 2025, attracting massive inflows from both institutional investors and central banks. We will also dissect Bitcoin's wild ride, explaining how its sensitivity to liquidity conditions caused it to soar and then retreat. By examining their reactions to the same big-picture events, we can better understand their roles in an investment strategy. Is gold the reliable anchor in a storm? Is Bitcoin the high-powered engine that thrives on monetary expansion? The story of 2025 provides compelling answers to these critical questions. The narrative of gold versus Bitcoin in 2025 is more than just a story of numbers on a chart. It is a story about investor psychology, institutional behavior, and the powerful, often unseen forces of global monetary policy. It highlights how an asset with thousands of years of history behaved exactly as expected, while a 15-year-old technology asset revealed its deep connection to the flow of money in the digital age. By the end of our analysis, you'll have a clearer framework for interpreting their movements and understanding what signals to watch as we navigate the economic landscape of the future, helping you to anticipate which asset might lead the charge next. Gold's performance in 2025 was nothing short of spectacular, reaffirming its age-old status as the ultimate safe haven asset. As the year unfolded, a growing sense of unease settled over global markets. Stubbornly high inflation refused to be tamed by central bank policies, and the risk of a significant economic slowdown loomed large. In this environment, investors prioritized one thing above all else: capital preservation. They sought an asset that would not only hold its value, but also appreciate when other, riskier assets like stocks were faltering. Gold fit this role perfectly. Its rise was not a speculative frenzy, but a methodical and deliberate climb, gaining strength with each new report of economic weakness or geopolitical flare-up. The numbers tell a powerful story of this flight to quality. Throughout 2025, gold surged by over 60%, breaking decisively above the long-anticipated $4,000 per ounce mark. By October, it had reached a stunning all-time high of more than $4,370. This made it the best-performing major asset class of the year, delivering one of its strongest annual gains on record. This rally was not driven by fleeting headlines but by a deep and structural shift in investor sentiment. As credit spreads widened and equity markets wobbled, defensive flows poured into gold-backed exchange-traded funds, signaling a clear preference for tangible security over speculative potential in a high-risk world. The demand for gold was not limited to individual investors or even large financial institutions. A pivotal driver of its strength came from the world's central banks, which embarked on a historic buying spree. Nations like China, India, and Turkey continued to add massive quantities of gold to their official reserves, a trend that had been building for several years. In a landmark development, central bank holdings of gold surpassed their holdings of U.S. Treasury bonds for the first time in decades. This strategic shift was motivated by a desire to diversify away from the U.S. dollar, a movement known as de-dollarization, and to hedge against the very financial instability their own policies were struggling to contain. Ultimately, gold's journey in 2025 was a textbook example of its function in a modern financial system. It acted as a barometer of fear, rising as uncertainty grew. Its value is not derived from future cash flows or corporate earnings, but from its universal acceptance as a store of value, its physical scarcity, and its independence from any single government or financial system. When trust in those systems wanes, as it did throughout 2025, investors instinctively turn to the one asset that has preserved wealth for millennia. The year's performance was not a surprise, but a confirmation of gold's timeless and enduring appeal in times of crisis. While gold enjoyed a steady and majestic climb, Bitcoin's journey through 2025 was a far more dramatic and turbulent affair. The year began with promise, as Bitcoin, along with other risk assets, rode a wave of optimism. Through the summer, it was up approximately 30%, seemingly on track for another strong year. This rally culminated on October 6 when Bitcoin's price soared to a new all-time high of nearly $126,200. For a moment it seemed the digital asset was once again defying gravity. However, this peak proved to be a precipice. What followed was a swift and brutal correction that erased all of the year's gains and then some. The downturn was sharp and unforgiving. From its October peak, Bitcoin's price plummeted by over 36%, crashing below the $90,000 level and settling into the $80,000 range by December. By the end of the year, Bitcoin was down 7%, making it the only major asset class to post a negative return. This dramatic reversal stood in stark contrast to gold's steady appreciation and shattered the simplistic digital gold narrative that had gained popularity in previous years. While gold proved its mettle as a defensive asset, Bitcoin behaved more like a high-risk technology stock, falling in tandem with equities during periods of market stress and heightened risk aversion. The primary explanation for this volatility lies in Bitcoin's extreme sensitivity to liquidity conditions. Unlike gold, which is rewarded during periods of financial contraction and fear, Bitcoin thrives when money is cheap and abundant. Its major price moves are overwhelmingly driven by cycles of global liquidity. The rally to its peak was fueled by lingering pockets of easy money and speculative enthusiasm. However, as central banks held firm on their tight monetary policies and financial conditions became increasingly restrictive, the fuel for Bitcoin's fire was cut off. The asset that had benefited most from monetary expansion was now the one that felt the most pressure from its contraction. This price action was accompanied by classic signs of a market correction. On-chain data revealed that short-term holders, many of whom had bought in near the peak, were capitulating and selling at a loss. During the most volatile periods in November, crypto liquidations exceeded $500 million in a single 24-hour span. In contrast, long-term holders largely held onto their positions, suggesting they viewed the downturn as a consolidation phase rather than a structural failure. Bitcoin's performance in 2025 demonstrated that while it can generate spectacular returns, it remains a high beta asset, acutely vulnerable to shifts in the macroeconomic and liquidity landscape. It absorbed pressure first when conditions tightened, setting the stage for its dramatic fall from grace. One of the most significant, yet often overlooked stories of 2025 was the immense and strategic role played by central banks in the gold market. Their actions provided a powerful and unwavering source of demand that helped propel the precious metal to its record highs. For several years, a coalition of central banks, led prominently by the People's Bank of China, had been systematically increasing their gold reserves. This trend accelerated dramatically in 2025, with official sector purchases continuing at a pace exceeding 1,000 tons annually. This wasn't just portfolio tinkering, it was a profound geopolitical and economic statement about the future of global finance. The motivations behind this historic buying spree were twofold. First and foremost was a strategic push for de-dollarization. For decades, the US dollar has been the world's undisputed reserve currency, with central banks holding vast quantities of US Treasury bonds. However, growing geopolitical tensions and the use of financial sanctions have led many nations to seek alternatives that are not controlled by a single government. Gold, being a politically neutral asset with no counterparty risk, became the obvious choice. By converting dollar-denominated assets into physical gold, these central banks aim to enhance their monetary sovereignty and insulate themselves from potential financial coercion. This strategic accumulation of gold had a landmark consequence in 2025. For the first time in modern history, the value of gold held by central banks globally surpassed their holdings of U.S. Treasury bonds. This was a seismic shift with long-term implications for the international monetary system. It signaled a diminishing faith in the long-term stability and dominance of the U.S. dollar as the sole anchor of global finance. The steady, relentless buying from the official sector provided an incredibly strong and stable floor for the gold price, creating a foundation upon which investor demand could build, pushing it ever higher through the year. In stark contrast, Bitcoin received no such institutional endorsement from the world's monetary authorities. Despite its growing acceptance in the private sector, no major central bank has added Bitcoin to its official reserves. Its volatility, regulatory uncertainty, and unproven track record as a store of value during a true systemic crisis make it an unsuitable asset for the conservative mandates of central banking. While private institutions were dipping their toes into the digital asset space, the official sector gave its unequivocal stamp of approval to gold, cementing the yellow metal's role as the ultimate reserve asset and a key pillar of its 2025 outperformance. While Bitcoin's price action painted a picture of distress, another part of its ecosystem told a story of surprising resilience: the U.S. spot Bitcoin exchange-traded funds, or ETFs. Having launched in 2024, these products entered their second year of trading and faced their first major market downturn. One might have expected a mass exodus from these funds as the price of Bitcoin tumbled. However, the data revealed a different reality. Despite the sharp 36% price correction from the October peak, the total assets under management in these ETFs showed remarkable stability, demonstrating a sticky and committed investor base. The numbers are quite telling. At the market's peak in October, the U.S. spot Bitcoin ETFs collectively held approximately 1.37 million BTC. By late December, after the worst of the crash, that number had only fallen to around 1.32 million BTC, a decline of less than 4%. This indicates that the vast majority of ETF investors were not panic selling. Instead, they appeared to be taking a long-term view, weathering the volatility with the conviction that the downturn was temporary. This stickiness of capital stands in stark contrast to the rapid outflows often seen in other thematic or high-risk funds during a market panic. Within the ETF landscape, a clear leader emerged. BlackRock's IBIT fund solidified its dominance, growing its market share to nearly 60% of the total. By the end of the year, it held approximately 780,000 BTC on behalf of its clients. The success of a mainstream financial giant like BlackRock in gathering and retaining assets, even during a severe price drawdown, lent significant credibility to Bitcoin as a legitimate, investable asset class for the long term. It suggested that the demand for a regulated, accessible way to gain exposure to Bitcoin was not a fleeting trend, but a structural feature of the modern investment landscape. This underlying strength in the ETF market provides a crucial counterpoint to the negative price narrative of late 2025. It shows that while speculative, short-term traders were liquidated, a new and powerful class of long-term oriented investors had entered the market and was not easily shaken. These investors, accessing Bitcoin through familiar and regulated brokerage accounts, behaved more like traditional buy-and-hold investors than speculative crypto traders. Their resilience suggests a maturation of the Bitcoin investor base and provides a solid foundation of demand that could help fuel the next major rally when macroeconomic conditions eventually become more favorable. The crux of the 2025 financial story lies in the Great Divergence, the moment after August when gold's path continued upward while Bitcoin's turned sharply down. Both assets were reacting to the same overarching macro environment of tight money and global uncertainty, yet their responses were polar opposites. The key to understanding this split is recognizing that while both can act as hedges, they are fundamentally different instruments that thrive in different phases of the economic cycle. Their correlation rose during moments of acute stress, showing they were sensitive to the same pressures, but their ultimate performance depended on which aspect of the macro environment was dominant. Gold's outperformance was a direct result of its role as a defensive, risk-off asset. In an environment where investors are more concerned with losing money than with making it, they seek safety. Gold, with its millennia-long history as a store of value and its lack of correlation to the earnings of companies, is the ultimate destination for this type of capital. It performs best when fear is high, credit risk is widening, and confidence in the financial system is low. The persistent macro stress of 2025 created the perfect storm for gold, rewarding its defensive characteristics and attracting investors who were prioritizing the preservation of their wealth above all else. Bitcoin, on the other hand, ultimately behaved as a risk-on asset, albeit a unique one. Its value is highly sensitive to the availability and cost of money, what economists call liquidity. When central banks are printing money and interest rates are low, excess capital flows into speculative assets in search of higher returns, and Bitcoin has historically been a prime beneficiary of this dynamic. However, 2025 was defined by the opposite: tight liquidity. Central banks were holding rates high to fight inflation, making money expensive and scarce. This environment starves high-beta assets like Bitcoin of the fuel they need to rally, leading to consolidation and correction. This difference explains why their paths split so dramatically. Gold was rewarded for the presence of economic stress and contraction. Bitcoin, conversely, was punished for the absence of monetary expansion. The so-called digital gold narrative faltered precisely because Bitcoin did not act like gold during the most critical test. When market stress intensified in the final quarter, Bitcoin fell alongside the Nasdaq and other tech-heavy indices, confirming its status as a high-beta liquidity play rather than a true safe haven. The divergence was not a failure of one asset and a success of another, but rather a perfect illustration of their distinct and complementary roles in the financial ecosystem. To truly grasp the divergence between gold and Bitcoin in 2025, one must understand the concept of liquidity. In simple terms, liquidity refers to the ease with which money flows through the global financial system. When liquidity is abundant, or loose, interest rates are low, borrowing is easy, and there is a lot of cash looking for a home. This often fuels bull markets in assets like stocks and cryptocurrencies. Conversely, when liquidity is scarce, or tight, interest rates are high. Borrowing is difficult, and money is expensive. This tends to put pressure on asset prices as investors become more cautious and capital becomes harder to come by. Bitcoin's entire life cycle has been intricately linked to these global liquidity cycles. Its most explosive rallies have occurred during periods of massive monetary expansion, such as the quantitative easing programs that followed the 2008 financial crisis and the COVID-19 pandemic. In these environments, Bitcoin acts as a sponge, absorbing excess capital and delivering outsized returns. It is, in essence, a high-powered bet on the expansion of the monetary base. The problem in 2025 was that this engine was thrown into reverse. Central banks, determined to quash inflation, kept financial conditions tight, effectively draining liquidity from the system. Gold's relationship with liquidity is far more complex and often inverse to Bitcoin's. While an extreme liquidity crisis can harm all assets, gold generally performs well during periods of monetary tightening and economic uncertainty. This is because tight money often precedes or accompanies an economic slowdown or recession. As investors anticipate this downturn, they sell their riskier assets and move into the safety of gold. Therefore, the very tightening of liquidity that acted as a headwind for Bitcoin became a tailwind for gold, as it signaled growing risk and a need for a defensive asset. Gold is rewarded during the contraction phase, while Bitcoin waits for the expansion phase. This dynamic explains why the two assets can move together during a sudden shock, as both may initially be sold for cash, but diverge over a longer cycle. The 2025 experience was a masterclass in this principle. Bitcoin's price drop was not a sign of a fundamental flaw in its technology or network, but rather a predictable consolidation under intense liquidity pressure. It was the first to absorb the shock of tight money. This high sensitivity, however, is a double-edged sword. Just as it falls quickly when liquidity tightens, it is poised to respond aggressively and lead the next rally as soon as conditions begin to ease. Beyond the fundamental drivers of liquidity and sentiment, technical analysis of the charts provided compelling clues about the shifting relationship between gold and Bitcoin in 2025. One of the most telling indicators was the BTC-XAU ratio, which measures the value of Bitcoin priced in ounces of gold. This ratio is a powerful tool for visualizing the relative strength between the two assets. Throughout the year, this ratio deteriorated significantly. By December, Bitcoin's value had fallen to approximately 20 ounces of gold, its lowest level since early 2024, and a critical technical support level that had held in the past. The breakdown in this ratio was technically significant because it represented the loss of a 3-year uptrend. Since late 2022, Bitcoin had been consistently outperforming gold, with the BTC-XAU ratio making a series of higher lows. The sharp decline in late 2025 broke this pattern, signaling a major shift in market leadership from Bitcoin back to gold. For chart watchers and technical traders, this was a clear bearish signal for Bitcoin's relative performance, and a confirmation that the macro environment was far more favorable to the precious metal. The sustained dominance of gold was not just a feeling, it was mathematically visible in the charts. Further technical indicators painted a picture of a market that was becoming extremely oversold. The weekly relative strength index, or RSI, for the BTC gold pair plunged to 29.5. The RSI is a momentum oscillator that measures the speed and change of price movements, with readings below 30 typically indicating oversold conditions. This was the lowest RSI reading in nearly 3 years, suggesting that the move in favor of gold relative to Bitcoin had become overextended and was potentially due for a pause or a reversal. Some traders even noted a bullish divergence on the daily RSI, where the indicator started to rise even as the price ratio made new lows, often a precursor to a short-term rebound. And however, the dominant macro narrative continued to weigh on sentiment. In December, Cleveland Fed President Beth Hammack, a future voting member of the rate-setting committee, cast doubt on the significance of a recent soft inflation report, signaling that interest rates might need to remain on hold for several more months. This statement underscored the reality that Bitcoin had not benefited from any actual policy easing in 2025. The technicals were showing signs of exhaustion in the downtrend, but the fundamental trigger for a sustained reversal, a clear pivot toward easier monetary policy, had not yet arrived, leaving Bitcoin in a vulnerable position as the year came to a close. As we move forward from the great divergence of 2025, the central question for investors is, which economic environment will take shape next? The future performance of gold and Bitcoin will be almost entirely dependent on the answer. The key signals to monitor are clear: the direction of interest rates, the overall state of global liquidity, and the level of investor risk appetite. If the macro stress that defined 2025 deepens, or if central banks are forced to keep monetary policy tight for longer than expected, gold is likely to continue outperforming. Its role as a defensive store of value will remain paramount in a world dominated by fear and capital preservation. Conversely, Bitcoin's future rally hinges on a shift in these very conditions. As a high-beta asset with extreme sensitivity to liquidity, Bitcoin is poised to lead the charge as soon as the financial environment begins to thaw. The first signs of a modest easing cycle from central banks, whether through forward guidance, a pause in tightening, or actual rate cuts, could act as a powerful catalyst. Such a pivot would signal to the market that the era of tight money is ending, likely shifting investor focus away from protection, meaning gold, and back toward opportunity and growth, meaning Bitcoin. Given its sharp correction, Bitcoin has the potential for an outsized move to the upside when this shift occurs. Investors should pay close attention to the language used by central bankers at the Federal Reserve, the European Central Bank, and other major institutions. Are they more concerned with fighting inflation or with supporting growth? A subtle change in their tone can precede a major policy shift. Likewise, monitoring credit markets and leading economic indicators can provide clues about the health of the economy. A sudden spike in credit risk could favor gold, while signs of a resilient economy might embolden risk-takers and benefit Bitcoin even before official rate cuts begin. The timing and nature of any policy easing will also be crucial for Bitcoin's response. In conclusion, the paths of gold and Bitcoin are not random. They are driven by predictable reactions to the macroeconomic landscape. The divergence of 2025 was not an anomaly, but an illustration of their fundamental properties. Gold is the asset for a world of contracting liquidity and rising fear. Bitcoin is the asset for a world of expanding liquidity and rising optimism. By monitoring the key signposts of monetary policy and economic health, investors can position themselves to anticipate the next major shift in leadership between the ancient store of value and its digital successor. The dance between these two remarkable assets is far from over.